Hey there, Blockhead traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. Today is May 27th, 2023, and this is Blockhead Traders Weekly. In this week's episode, it's just myself, Sprocket888, and I'm going to take a look at options and futures. But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading. Love to hear what type of content you want to hear about. I also want to mention thetagang.com/Sprocket888, where I post each and one of my trades, the good, the bad, and the ugly. You can also pick up this wherever you get your podcasts and listen to this in an audio-only format. And if you can't find it wherever you pick up your podcast, let us know and we will get it there. But let's hop to this week's content, options and futures. So I wanted to kind of build a little bit upon last week's episode where I kind of took you through my portfolio and what are the key metrics that I look at as far as theta and delta are really the two key performance indicators that I keep tabs on in my portfolio daily. And that really gauges, how healthy or sick is my portfolio? What do I need to do to make adjustments to keep that kind of rolling forward? And to build upon that, I wanted to kind of jump into some of the products that I like to trade this week. Now, I'm at a slight disadvantage because the market is actually closed right now. And so when I take you through some of the screenshots for picking up trades and things like that, the quotes are a little bit off because the market is closed. It's a long holiday weekend this weekend. So some of that won't be as accurate as it would have been should there been active trades. However, what I want to kind of talk about, and we've touched on this in many previous episodes, but I thought I'd bring it back up here on a focused episode, and that's futures and options on those futures. Now, there's a couple of things that I really like about options and futures. The first is the choices are not so plentiful. And you might think, well, why is that a good thing? And the reason that's a good thing is because in the equities market, there's just so much to pick from. And you got to be pretty diligent on your different screeners, your criteria. So some things kind of fit, some things don't. You end up, it's kind of cool because you get to try a lot of tickers, but you get pretty comfortable when you start having your set of tickers that you like to trade. If I look back at my portfolio when I first started, I would dabble in anything that hit my screeners. And then over time, I started getting more comfortable with certain names. And so my equities, maybe I touched on 50, 60 different equities. After I had about a year and a half on my belt, if I looked back at my portfolio, I'm really touching maybe about a dozen to a dozen and a half different equities. And so in the futures world, there's actually not a ton of futures products, let alone those products that actually have options. So the amount of screening that you have to do is kind of a lot less. I pretty much just have a rough volatility that I'm looking for, and I check the charts to see where they fit. And there's probably a total of maybe 6 to 7 different futures products that I ever end up touching, with the majority of them being indexes. Now, there's two other things that I really, really like about futures. The first one is the way that margin is calculated. In the futures world, they use what's known as span margin. In equities and the options in equities, they use what's known as Reg T margin. Now, there's a thing called portfolio margin in equities, and that varies by broker, but typically you have to have at least 120K, sometimes 150K in total liquidity in your portfolio before you qualify for portfolio margin. So that's really not something that very many traders, or at least retail traders, have. And so the majority of people in their brokerage accounts are going to have a Reg T margin. And that's what I have in my brokerage account. And the Reg T margin is pretty, I'll say, stringent on the amount of capital that you have to put up into trades. And it's not really based on total risk. It kind of is. However, it doesn't take into account, the probability of certain events and things coming into, at least not in the same way that span margin takes into account. Now, span margin is something that only exists in the futures world and futures products. And span margin, every portfolio qualifies for it. There's no threshold in the world of futures before you qualify for span margin. So as long as your account is active or authorized to trade futures, which is usually just a checkbox in your brokerage account to say, hey, I'd like to trade futures. And as long as you have like $2,500, they're going to turn it on for you and they'll let you play in the futures world. And what that actually does is the amount of buying power that you have to put up to make a trade is dramatically reduced. I mean, like an order of magnitude reduced. And I'll pull one up here just to show you. We've done this before on different episodes and things like that. But let's take a look. Now, one thing to keep in mind before I show these two things is we have to keep in mind what a notional value is. And that is what type of capital does one of these option contracts represent. And the first one that we'll look at is the future of ES. Now, this is the S&P index, and this one contract of this future represents a notional value of $210,000. So that's a whole lot of capital. And in span margin, the amount of that you have to put up, you can see down here in the lower right corner, $10,394. So I picked the 4,200 strike, 4,200 put. Depending on what strike and what delta that actually is, will change a little bit about that buying power. But for the purposes of showing you the difference between span margin and Reg T margin, we're going to use the same strike in both the futures product and then the similar corresponding equities product. So right here, we got about $10,000 in buying power for $210,000 of notional value. Now, when we switch over to the equities world, we're going to look at a product called SPX. Now, SPX is also the S&P index. It's the full size S&P index. And so again, I picked the $4,200 strike. Now, the notional value of this is actually $420,000. So one contract of SPX is double the notional value of the futures. However, if you look at the buying power needed to trade one option contract on SPX, it's $88,618. So if there happened to be a similar notional size product, there's not. You would have to divide this by 2 to get that $210,000 notional value of the one futures contract notional value, and that was, remember, $10,000. So even if you cut that in half, this is still $44,000 of buying power that you had to pony up. So you can see it's roughly, a little more than 4 times the amount of buying power needed to trade in an equities world. Now, these products are huge. There are smaller versions of this, but I just wanted to use this as an example. They're all similarly sized when you talk about buying power, and that span margin really reduces the amount of capital that you have to put up for the trade. And what that allows you to do is kind of increase your leverage per se, to not consume as much of your portfolio or your buying power to put more trades on, which means your return on capital is much higher in the futures world because you don't have to put up as much buying power, and the returns that you get are quite a bit larger than in the equities world. So your ratio of how much premium are you collected divided by your buying power is much, much, much more favorable in the futures products. Now, the last thing that I really like about futures products is one of the tax benefits of futures, and that is they are a 1256 contract. So that's a tax classification of this particular financial product. What that actually means is the tax rate that you are taxed on when you deal with futures, options on futures, everything in that world is a 60-40 split. What that means is 60% of all of your gains are taxed at the long-term capital gains rate. So whatever your long-term capital gains tax rate is, that is what they are taxed at. You do not have to fulfill the 1 year or greater holding period to qualify for that. Every single futures product is taxed at that 60-40 split. So 60% are long-term capital gains and 40% are taxed at short-term capital gains. Again, whatever tax bracket you fall into for that short-term capital gains tax, that's what you are going to pay. Now that's super nice because most of these trades are all going to be short-term trades. They're all going to be in and out in a month, a couple weeks, things like that. So they're never going to really qualify for that long-term capital gains tax rate, which is significantly less than short-term's rate. However, because they're 1256 contracts, 60% of my profits are actually taxed at that lower tax rate, and only 40% are actually taxed at the short-term rate. When you are in equities world, almost everything you're trading in equities world will be taxed if you're doing the same time frame as these trades at 100% short-term capital gains rate. So again, just another nice benefit to put just a tiny little more juice in there in your trades. So again, the three things that I really like about futures are the opportunities. The financial products are much more limited, so you don't have to pick and choose from such a small list. They are much better margined with span margin, so your buying power can be much more efficient when you're trading them. And lastly, your capital gains that you pay on futures are much more in your favor with 60% going to long-term rates, while only 40% of your gains taxed at short-term rates. Now, let's take a look at what I'm kind of following here when I go look at these futures. And, one of the drawbacks, because there's not so many futures, is the entry points of when it's okay to, or when it fits my risk threshold and trade setup in futures is not really always present. So I kind of got to keep an eye on them and see, when something is ready to go. And today, unfortunately, there's really not a lot of futures out there that I follow and watch that's really ready to go. Some of my favorites are the S&P, oil, natural gas, the Russell Index. But right here is a watch list I have of all the futures that have options on them. And the ones that, well, there's a few more that have options, but the spreads and liquidity are pretty poor. So these are really the ones that I kind of look after. And my idea of IV percentile, you might have seen me do that in other videos, doesn't really apply when I'm trading futures, just because of the way the contracts roll over so frequently. That IV percentile is not really that accurate. And so I focus more on the actual implied volatility. So a lot of times I'll sort by implied volatility, and the types of products that I'm going to look for are, I like indexes when they're 20%, I'll trade them down to 20% volatility on an index. I prefer 25% volatility or higher. And if they ever really hit 35%, I pretty much always put a trade on if the volatility gets in the 35% range. They're not there today. So this is sorted by implied volatility. So you can see the Russell is sitting at 20% volatility. The S&P is at 18% volatility. So these are really, really at the bottom end of what I like to trade. So it's not really at the time for me to put on a trade there. Now, outside of the indexes, I usually like to see volatility higher than 35%, depending on what it is. So one of the things, wheat futures are something that I like. I like wheat futures above 35%. Right now they're at 34%. So wheat futures are definitely at a range where I would start kind of looking at the chart, seeing what the price action is. Oil, I like to see at 50%, 35%. Oil is currently at 54. So again, oil lately has been in 60 to 80% volatility. So this is a little bit lower for oil, but again, 54% on a commodity of oil. That's something I would look at. Looking at here, the Russell, I already have a trade on the Russell. S&P is a little bit low. Let's go ahead and look at oil, because oil is sitting there at 54%. And what I'll do is I'll send this over to the options chain, and then I'll go bring up the options chain, and we'll take a look at the options chain to see what's going on with oil. And what I like to look at here is a couple of things. The first thing I check is what futures contract is trading. Now, the futures contracts change depending on what type of commodity is. So on indexes, they change quarterly. On commodities, they almost change monthly. And so right now, there's the active contract is CLN. There 24 days left, and I usually don't touch options that are from the next futures contract until that contract is active. The only exception to that is just before they switch which contract is active, you'll see the volume start to pick up in that next month's contract. Right now, you can see there's a huge volume difference where CLN is about 250,000 volume, and that next month contract is only about 71,000, which means the option chains I'm going to look at are going to predominantly stick to this CLN number. And you can tell what they are by kind of looking at the first part of the symbol here. So the only three option chains I have available to pick from here are CLN 6 days out, CLN 13 days out, and 18 days out. So, I'm going to go probably with the 18 days out, which is still before the CLN futures expire. And let's go ahead and take a look. So I'm going to slide on down here, and typically what I like to do is really kind of start around maybe a 20 delta, 16 delta. We got, now see, this is where the spreads are kind of wide here. We got a 68 strike, and we can come up here to like see this distance here. This is all because the markets are kind of closed. So probably to gauge where I might want to go with this, I'm going to flip over and look at a little bit here, because kind of gauging, where is oil kind of sitting right now. And it's a little bit of in a range where you can see we got a low back here of 66-ish. We have this one terrible wick down to 63. But largely that candle, this daily candle, closed at around 67. We're kind of a little bit in a downtrend to some degree, I guess you could say. You could also look at this and say we've got a couple of higher lows, so we could be going higher here. I'll kind of balance that a little bit with my RSI indicator down here, and interestingly, this is kind of right in the middle. And when this is kind of in the middle, and I'm kind of looking that this could be a range where, maybe this is kind of in a range, I might err on the side of pulling a strangle on the option chain. And a strangle is basically a short call and a short put, basically both sides of the trade. Let's go ahead and go back to that options chain. And when I'm doing a strangle like this, I'll probably just start with a 16 delta strangle. That means I'll look at the 16 delta on the put side and a 16 delta on the call side, and then we'll kind of adjust from there. So at 18 days out, the 16 delta on the put side looks like that is a 66.50. So I'll go ahead and put a 66.50 on here, and then I'll scroll down looking for the 16 delta on the call side. There's not really a 16 delta, so I got a 14 and an 18. I'll go ahead and take the 18, which is 78. And just to make this pretty, let's change this to 67 so we're not dealing with those 50 cents. And then let's go take a look at what we've got on our P&L. I can see that my credit is $1.14 for buying power risk of about $7,000. Now, the notional value of oil is a little bit different. So in the equities world, you might think, oh, that's $114. But actually, in the futures, this notional value of this product is different, and so that's actually $1,140. So a little bit over $1,000 in premium collected. Now, the next thing I'm going to do is adjust the standard deviation. So this gray area is basically telling me what it's going to look like on May 27th. This is 18 days out for the end of the month expiration, which will probably be, I think it's usually the first Tuesday of the next month. And so here we've got this gray area is marked out as the most likely standard deviation move expected by that expiration. And I guess the part that I'm going to kind of put in here and what I'm looking at is really my delta and my theta. And so the delta, this is relative to the CL. So that's not so important because that beta weighted delta is what I look at from the episode last week. If you go back and pay attention to that, but this theta is what really matters. And this trade actually would add 80 points of daily theta to my portfolio. And if you remember from last week's episode, I'm kind of targeting around 75 daily thetas. And so picking up this trade at this point is actually going to grab 80 thetas, which is huge. Now, one thing to remember, or at least to kind of take into consideration here, is a lot of times commodities can just pop one way or the other pretty heavily. And so I'm always cognizant of that when I kind of look at this stuff. And so, you can see here that my break even is going to be just under $80, about $79. And I will flip back to the chart and I'll kind of look at this to be like, as far as price action goes, how at risk am I for this $79? And this is definitely a value that's on the fence here, because you can see historically on the daily chart, we've kind of bounced off of this range, rejected off maybe $79 to $80 in here. We did surpass it once here, coming up as high as 82. So this is something that I, might enter, might not enter. The reason I say that is because if you look back here, if we were to pop up to $82, you can see my expected profit and loss would be, over a 3K loss. Now I can control some of that by pushing up this put as we get closer and closer to challenging the strike. But basically this is a 10% move up would be this dotted yellow line, and a 10% move down would be this dotted yellow line. And so this would be a delta neutral trade as long as oil stays plus or minus 10% from where it is right now. If I wanted to modify this a little bit and say, let me wait until oil gets closer to challenging that, $80 mark before I were to put on a call, what I would do, go ahead and clear this one off. I'd come back in here. Let's go ahead and put my $67 put back on. And now this won't be 10. It will probably be the split difference here of 467 and 10. What would that happen to be? I don't really know. It would probably end up being maybe around 65 cents. Is probably what that put would end up looking like. So that's $650 as long as oil stayed above 66 would be my break even on the bottom side. And I would balance that against that chart, flipping back there, okay, where is that? Okay, well, the most recent low was 63. The wick down was 63, but the candle actually was around 68. So this might be a little bit more comfortable of a trade, and then it can always kind of come back to that, put the call side on later. And so if we hop back, you can see the buying power there is 6,800 for $650 of premium collected. And just picking up that put only, not picking up the call, you can see my theta is still 43 theta, which is not too shabby of a theta to pick up, but it's certainly less than the 82 theta if you pick up both sides of the trade. So just something that you have to keep in mind and consider when you're looking at those options and things like that. So that is an example of one of the futures option products that I like to trade and how I kind of flip through it to decide if that's a setup that I want to take. Right now, I'm not going to engage in that. I'm probably take a look at them in a little bit. They're, like I said, all the futures are just about where I want to trade them, but not quite. And so if I just give it a little time to see if they'll slide into a more appropriate trade setup for me, that will be a more comfortable entry and I'll feel better about it. Additionally, I still have quite a few trades on, so I'm not really looking to add a lot of theta right now. My deltas are well under control. When it comes to my portfolio, I think my deltas against the S&P are around 40 is the delta. So still delta neutral, tilted a little bit preferential to the long, but 40 is a pretty respectable new delta neutral for me. based on the last week's episode numbers. And my daily theta presently on my portfolio is like about 120. So that's super awesome to be around that 120 mark where my target is 75. So to have delta neutral and to be well over my daily theta target within the confines of my buying power is a great setup for my portfolio to be in right now. And so I'm just going to kind of wait. I got a couple of trades on there that are getting close to hitting the I'm done cooking. And when those come off, I might be looking for more deltas. Maybe by that time, the futures will be a little bit more attractive for my trade setups. And I'll be able to flip through the half a dozen or so ones that I typically trade and find a nice entry to really pick up a lot of theta power. That is one thing that the futures are really good about with that span margin, that notional size. They usually can bring a very large daily theta hit to your portfolio. So you do have to be a little bit careful on the setups because they are very large notional value products. And you do have to kind of watch them a little bit because once they get a little bit out of control, they're really hard to rein in and keep under good risk management practices. Not impossible, but a little bit more difficult than equities, particularly because taking assignment on a future is not quite like taking assignment on an equity from a standpoint of an equity is pretty much good forever. So once you take assignment on the equity, you've got a lot of time to battle back, sell calls against it, stuff like that. In the world of futures, the underlying future itself also expires. And so if you take assignment on a future, you typically don't usually have a ton of time before that future product actually expires as well. So it's kind of a double expiration. Your option expires and the underlying future expires. And so I've never really tried to take assignments on futures because if you do, you really don't ever have any time to battle back or collect premium on that you've taken assignment on. So I don't typically enter futures with the expectation of it's okay for assignment like I do in equities. And so that dynamic is a little bit different. And that's one of the reasons why I say your risk management varies just a little bit in futures because it's not really as comfortable as, oh, if it doesn't work out, I'll just take assignment and sell some calls against it and work my way back up because time is still against you because that underlying future does have an expiration date as well. So hope you found some useful information buried in there. If, something sparked some curiosity in you, I encourage you to Google about it, hop into our Discord, ask some questions. I really, really love premium selling and kind of talking about premium selling. And so talking through at least my thought process, I'm always happy to do that, give you some pointers here, there. Lots of other people take and they take it and twist the premium selling to their own style, their own flavor, which is perfectly fine. There's lots of opportunity and options out there for you to add your own little twist to things. So good luck out there. We got some important debt ceiling numbers coming up this week in trading. We'll see what that does to the indexes and the overall market. I'm sure it will have some type of impact. How long and how big that impact is, nobody really knows. But if we get a lot of movement and volatility, you can bet that I will be on the lookout for some premium selling plays as that volatility would likely increase in the event of some major movement down or up in the market. So good luck out there. And remember, think outside the block.